Okay, this is the solution to the example in lesson 4, the additional example. It's entitled Additional Example of Consolidation for Wholly Owned After Acquisition with Differential. And just to sort of recap, I assume you've taken a look at this problem on your own by now, just sort of checking to see if you did it correctly. Suppose we assume that on January 1st, 2001, Big purchased 100% of Little for $350,000, and they had a bunch of misvalued assets and liabilities. And the first requirement was to perform the differential analysis, again comparing the fair value of the investment versus its book value, and then figuring out why we paid either more or less than book value. So in this example, again, the fair value of the investment was $350,000. The book value of Little was $300,000, so there's a differential of $50,000. And again, why did we pay $50,000 more than book value? Well, there were a number of misvalued assets and liabilities. First among these, inventory was undervalued by $20,000. And again, if inventory is worth more than book value, that means we'll pay more than book value to acquire the subsidiary. So that explains away part of that overpayment from an accounting perspective. So we subtract that. Next, we had some overvalued property, plant, and equipment. Now, if an undervalued asset is subtracted, then an overvalued asset would be added. We also had some undervalued bonds. And again, there are a number of ways we can decide whether to add or subtract this. For me personally, the easiest way to approach this is to start from the position of undervalued assets, because that's sort of intuitively very easy to follow. Undervalued assets are subtracted. From an accounting standpoint, liabilities are essentially the opposite of assets, so they should be treated in the opposite fashion. So if we subtract undervalued assets, then we would add overvalued liabilities. Next, we have some in-process research and development costs. And again, in an acquisition, we're allowed to treat those as an asset. That's an asset which is not recorded on the books of the acquired company, but that explains one of the reasons we paid that extra money for the subsidiary. And then finally, by the same token, we have a customer list which we value at $30,000. So of the $50,000 differential, we've explained part of it. The remaining differential is $55,000, which we simply attribute to goodwill. The second requirement was to go ahead and record the equity method entries for Big accounting for their investment in Little. And again, it's always going to be the same thing: income, dividends, and amortization. Looking at the trial balance in the worksheet that you had, Little's net income was $40,000. Big owns 100% of Little, so Big owns 100% of that $40,000 of income. Next, for dividends, again, looking at the worksheet, we see that Little has a dividends declared account of $30,000. That means they paid $30,000 in dividends. Big, as the sole shareholder, received all $30,000. And then finally, amortization. We have all of these differential assets that we recorded on the previous slide, and all of them except for the goodwill have a finite life, which means all of them are going to need to be amortized over their finite lives. First, we had the inventory differential. And again, there are a number of ways we can interpret this. Inventory was undervalued by $20,000. That means that from our perspective, Little's inventory was undervalued, which means that when it's sold, their cost of goods sold is undervalued, which means they're overstating their income. And so what we're doing here is we're going ahead, and since they overstated their income, we overstated our investment income. So what we're doing here is we're actually reducing our investment income to correct that misstatement. Similarly, the property, plant, and equipment differential, again, it was a $50,000 differential for assets with a 10-year life. And again, they had $50,000, their property, plant, and equipment was overvalued by $50,000. That means that their depreciation expense was overstated, which means their income was understated. Since they understated their income, we understated our investment income. So what we're doing here is we're going to go ahead and credit investment income for $5,000 to fix the, in essence, fix the reported income of Little. Likewise with the bond differential. The bonds were undervalued by $10,000, so essentially these bonds are worth more than book value. there would be a premium, and we know that amortizing a premium on a bond liability reduces our interest expense. So again, from our perspective, the true interest expense should have been lower, which means the true income should have been higher. So we're going to go ahead and increase our investment income by $2,000. Same thing with the research and development differential. There was a $5,000 of in-process R&D that we capitalized as an asset. Half of that has now been used up or consumed and needs to be written off. So we're going to go ahead and reduce our investment income and eliminate that portion of our investment asset that has been consumed. And then finally the customer list, the same argument. A $30,000 customer list which has a 4-year useful life. So it's going to be written off at $7,500 per year. So we're going to expense the portion of that customer list that's been consumed and go ahead and reduce our investment in little account, because again, our investment in little includes that $30,000 for the customer list. Finally, as was mentioned in the statement of the problem, at the end of the year, BIG determines that due to impairment, the correct goodwill balance should be $40,000. When we first recorded this, we assumed there was $55,000 of goodwill, and so we're going to go ahead and basically write off $15,000 of our investment balance, saying that it has been lost due to the impairment of that goodwill. The third requirement, the elimination entries. And again, we're going to have this nice acronym working for us. First, the S entry for subsidiary equity, if you will. We eliminate the subsidiary's beginning of year equity accounts, pulling these straight off of the worksheet. And again, the main thing to keep in mind at this stage is that we're eliminating the beginning of year equity accounts, which means the beginning of year retained earnings. The beginning of year retained earnings is up in the statement of retained earnings as beginning retained earnings. Retained earnings down in the balance sheet portion of the worksheet is the end of year retained earnings. And then we go ahead and record those various differential assets. Again, the inventory is undervalued by $20,000, so we're going to go ahead and increase inventory by $20,000. Their property, plant, and equipment was overvalued by $50,000, so we're going to go ahead and reduce property, plant, and equipment by $50,000 with a credit. Their bonds payable were undervalued, so we're going to go ahead and increase their reported bonds payable. And again, we're not going to actually change the bonds payable account. We're going to go ahead and add to the premium on bonds. We go ahead and record that in-process R&D asset. We go ahead and record that customer list worth $30,000. We record the goodwill of $55,000, and we'll impair that in just a moment, but it's nice to start out with the beginning of period balances. And if you add all that stuff together, that equals our beginning of year investment balance of $350,000. Next we go to the A for amortization entry. And again, we've got 2, 4, 5 finite-lived differentials, plus we have the goodwill. All of them are going to need to be amortized or adjusted. First, the inventory. We assumed inventory is on a FIFO basis, which means that that $20,000 of additional inventory at the beginning of the year, by the end of the year it's been sold, and that $20,000 of additional cost needs to be transferred to cost of goods sold. So we eliminate inventory and transfer it to cost of goods sold. The in-process R&D, $5,000. Again, that has a 2-year life, so we're going to go ahead and write off half of that as R&D expense. And again, the worksheet, I had to be sort of stingy with lines on the worksheet, so we'll go ahead and take the R&D expense and the customer list amortization and just post those to the operating expenses in the worksheet. The customer list, again, $30,000 customer list we just created. It's got a 4-year life, so we're going to go ahead and write off $7,500 of it as amortization expense. The property, plant, and equipment, again, a $50,000 differential being amortized over 10 years. In the S entry, we credit property, plant, and equipment, so to amortize it, we debit property, plant, and equipment. And again, what we're doing is we're essentially arguing that Little has been over-reporting their property, plant, and equipment, which means they've been over-reporting their depreciation expense, and we're going to go ahead and reduce the depreciation expense being reported in the consolidated income statement. Likewise, with the amortization of the bond premium, we all know that when you amortize a bond premium, that's treated as an adjustment to your interest expense. And then finally, that goodwill impairment loss. Again, the goodwill was put on the books at $55,000. The correct end of year value was $40,000, so we had to go ahead and write off $15,000 of that. Next we have I for investment income, and again we're looking at the trial balance, looking at the worksheet. Big company had investment income of $2,000. That has to be eliminated. Investment income is a credit balance if positive, so we're going to go ahead and debit investment income to get rid of it, and credit investment in little. And then finally, D for dividends, we eliminate the subsidiary dividends by crediting dividends declared and debiting the investment in little. For the worksheet, I apologize for the small font here. It's admittedly difficult to get the entire worksheet onto a single PowerPoint slide. Now, to my mind, the hard part of this, the confusing part of this, is the elimination entries. We just went through, and I'm not going to scroll back to the previous screen, but we had about 8 or 9 elimination entries. And for every one of those entries, debits equaled credits. At this point of our lives, it should be impossible for us to do a journal entry where debits don't equal credits. It should make our skin crawl if we do that by accident. So we've got 8 or 9 or 10 journal entries with debits equaling credits, and now we're going to enter into the mechanical process of taking the debits and credits from the journal entries and posting them to the debit and credit columns in the worksheet. Again, under the fourth and fifth columns from the left under the headings eliminations, debit, and credit, that's just the data transcribed from the journal entries, and each of the numbers in those two columns has a little letter next to it, A or I or S or D, and the purpose of that is to keep track of which journal entry that number came from. So for example, the very first item there in the eliminations column is the $20,000 debit to cost of goods sold. It says $20,000 A. That means that came from the A for amortization entry. But again, this is just a mechanical process, posting debits to the debit column, credits to the credit column. After you do that, please take the extra 30 seconds to go ahead and foot those two columns. Make sure that your total debits to the debit column equals your total credits to the credit column. In this case, they both equal $494,000, looking at the very bottom row of the table. Much grief will be avoided if you take the 30 or 45 seconds and do that. If you foot those two columns and the debits don't equal the credits, that means you've made a mistake. And no matter what you do, your final worksheet is not going to be correct. So again, this should just be a mechanical process. Foot the two columns. If they're not equal, then you need to go back and double check. Did every journal entry get posted to the debit and credit column as appropriate? The only areas, well, two common areas of confusion here. First, the investment accounts. There are two accounts with the word investment in them. There is the investment income up in the income statement, and there's the investment in little down in the balance sheet. You need to be sure you are debiting or crediting the correct one. So if you don't just rely on seeing the word investment, you need to be aware, am I adjusting the investment income or am I adjusting the investment in little? Secondly, there are two retained earnings balances. There's beginning retained earnings and there's ending retained earnings. In these elimination entries, we always adjust beginning retained earnings. The ending retained earnings is the end result of the consolidation process, but we always adjust the beginning retained earnings. Okay, finally, Part 5 asked for the next year's initial elimination entry, that is the S entry. What we do in 2001 in this example sets the stage for the first entry in 2002. And again, we have our, in the S entry we eliminate the subsidiaries, beginning of year equity accounts. The common stock and additional paid in capital are still $50,000 and $100,000. There weren't any changes to those. Retained earnings is now up to $160,000. It was $150,000 at the beginning of last year. Add $40,000 in income, subtract $30,000 in dividends. The end of year 1, beginning of year 2 retained earnings is now $160,000. The inventory differential is gone. Again, look back to the elimination entries in 2001. In the S entry, we debited inventory for 20,000. In the A entry, we credited inventory for 20,000. So we're carrying forward a net 0 in inventory. Likewise, the in-process R&D, back in 2001, in the S entry, we debited it for 5,000. In the A entry, we credited it for 2,500, which means we're carrying forward 2,500. Similarly for the customer lists. Last year we initially debited customer list for 30,000 and then we amortized 7,500 of it, so we're carrying forward 22,500. Goodwill, in the S entry we created 55,000. In the A entry we wrote off, we impaired 15,000, taking it down to 40,000. Property, plant, and equipment net, in the S entry we credited it for 50. In the A entry we debited it for 5, so we're carrying forward a net 45,000. Likewise, the premium on bonds payable. We initially created a $10,000 premium, we amortized 2,000, which means we're carrying forward 8,000 to the following year. And finally, the sum of all that stuff equals our end of 2001, beginning of 2002 investment in little account.